But the market said, wait a minute, you said, Michael Saylor said he's never going to sell Bitcoin. Michael Saylor corrected that. He said, I said for you to never sell your Bitcoin. He said, I have never sold my Bitcoin. Strategy, on the other hand, did sell some Bitcoin. So he clarified that. He said, you and I, we should not sell our Bitcoin. The company is playing a different game. In order to appease the regulators, they did that. So 32.
A financial asset designed to stay perfectly stable is now slipping below its anchor. And the real question is whether this is a temporary dislocation or the first crack in the entire system. A financial structure designed to behave like stability is now showing something very different underneath the surface. And the question is whether this is a temporary distortion or the moment the entire mechanism is being tested in real time. At its core, this perpetual preferred stock is meant to function like a yield-bearing digital credit anchored tightly around a $100 par value while paying an 11.5% return. In theory, the system is simple. If the price drifts away from par, yield adjustments should pull demand back in and restore balance. But what happens when that balance stops working smoothly? The price slipping into the high dollar ADS suggests that the usual forces are not responding as expected. Even with attractive yields, buyers are not stepping in fast enough to defend the peg, raising a deeper question about whether confidence, not structure, is the real anchor here. And this is where it starts to mirror broader crypto dynamics. In markets driven by sentiment and liquidity, does design matter if demand disappears at the wrong moment? Or is every stable structure only stable until it isn't? If yield increases fail to bring price back toward $100, then the real story is no longer about income. It becomes about trust, liquidity, and whether engineered stability can survive contact with the market. A financial structure built for stability is now breaking away from its anchor, and what happens next could redefine how investors view yield and safety in volatile markets. If this breakdown made sense of the situation, drop your thoughts in the comments, share this with others, and subscribe for more deep market analysis like this.
And it's a digital credit that pays you a yield. Right now it's paying 11.5% yield on a sort of fixed income asset. It's par. Let me explain how this works. So first of all, it's a stock, it's an equity, but it's what's called a perpetual preferred stock. Okay, so first of all, preferred meaning it sits up in the top of the stack, and it's perpetual meaning it goes forever. So there's no time frame, meaning in 5, 10, or 30 years, they have to give you your money back and you don't get any yield anymore. So this goes on forever. So as long as they hold your money, they pay you the yield. At some point, you can sell it to somebody else, but they never have to pay it back. That's a pretty big deal. Okay, then it's supposed to sit at $100 par, meaning it sits at $100, sort of like a money market account, meaning that if I put $100 in, I should always have $100. And it's paying me 11.5% yield, but it's not supposed to go up and down. I don't expect to make money with it. I don't expect my 100 to grow into 200 or 300, but I also hope I don't lose money with it. And I just want to collect. Right now, today, people are freaking out because the price is $89. It's supposed to be at 100, which means it's about 10%, 11% off of where it's supposed to be. You can see the dividend, 11.5%. So you can sort of see some of the information. Again, it's on the NASDAQ. You can buy it in your brokerage account. Now, how does this work? Well, the dividend is the dial that's supposed to work at this. So the goal is to keep it at $100 par. Okay, but how do they keep it pegged at $100? Well, they have a couple dials. Number one, they have a rate adjustment. So that means how much yield they're paying. So the more yield they pay, more people will buy it, obviously, and the lower the yield, less people will buy it. So they can adjust the yield, they can adjust the rate. And so they started it low and they've been raising it until they got it to 100. Then they have a yield reset. So every month they get a new dividend date, they get a new yield, and they can change that if they want. And then the buyers will return in to buy back. So it depends on price chart of Stretch right here. So we can see when they first started out and they were raising the rate. So right here at this line, it's about, this is about 90 right here. This was about 80. What do we got? Yeah, 80 sitting right here. So it launched at 80 and they kept raising the dividend higher and higher and higher to attract more people to it. And you can see the price has gone up pretty well. And here is $100 par where it got. So eventually they got up to there as they continue to raise the rates. But as you can see right now, we're sitting in this massive crash that everybody's freaking out over. Like, is this it? Is this the end? Did Stretch finally fail? No pegged assets ever work. Of course, short traders, we're going to try to destroy all these things. And we can see it's down about 8% right now.
A decision involving just 32 Bitcoin has sparked a market reaction far larger than the trade itself, raising one critical question about what really drives price in today's crypto landscape. A small but symbolic move from strategy is sending a much louder message to the market than the numbers themselves suggest. A temporary pause in Bitcoin accumulation, followed by the sale of just 32 BTC, has triggered outsized attention across crypto markets. On the surface, the scale is insignificant compared to a total holding of roughly 840,000 BTC, yet the reaction highlights how sensitive sentiment has become around institutional behavior. The key question is not what was sold, but why it mattered so much. In traditional finance terms, the move appears tied to credibility within credit markets, where demonstrating liquidity can carry more weight than maintaining ideological positions. That creates a clash between two systems: crypto-native expectations of never selling Bitcoin versus institutional demands for proof of balance sheet flexibility. What happens when perception becomes more important than volume? And how does that reshape price action when even token sales influence direction? At the same time, this situation connects to a much larger shift in global capital, where trillions in yield-seeking assets are slowly beginning to intersect with Bitcoin-linked structures. In that transition, even small signals can move markets, because trust, narrative, and institutional validation are becoming just as important as supply and demand.
Strategy did halt new Bitcoin purchases. All right, so they've been buying Bitcoin regularly, and they decided to halt Bitcoin purchases temporarily for one break. And then what they did, which seems to have disrupted the entire market, was they did their first Bitcoin sale that we've seen. 32 Bitcoin sold. Now let's put this into perspective, what happened and why. First of all, they sold 32 Bitcoin out of about 840,000 Bitcoin. They're buying thousands of Bitcoin at a time, and they sold 32. 32 is a drop in the bucket. 32 is inconsequential. But why did the market freak out over it, number one? And two, why did they even sell 32 if it's so inconsequential? A couple of reasons why. They are not playing a Bitcoin game necessarily. They're playing a financial market. It's a traditional financial market game. They're playing a stock and equity game. And in that world, selling credit instruments, they need credit ratings. And per the credit rating funds, some of them don't treat Bitcoin as actual capital. So they don't believe that even though they have $50–60 billion in Bitcoin assets, that they could actually use those assets to pay the debt if they needed. So strategy wanted to prove it. They said, okay, we'll prove it. We'll sell 32 Bitcoin. You can see how liquid it is, how easy it is to sell the money, sell it for money, and pay the dividend, and they did. Again, it was a token. It was a drop in the bucket. It was just proof, and what it did is it satisfied the rating agencies, which allows them to move to the next level in the credit game. But the market said, wait a minute, Michael Saylor said he's never going to sell Bitcoin. Michael Saylor corrected that. He said, I said for you to never sell your Bitcoin. He said, I have never sold my Bitcoin. Strategy, on the other hand, did sell some Bitcoin. So he clarified that. He said, you and I, we should not sell our Bitcoin. The company is playing a different game. In order to appease the regulators, they did that. So 32 Bitcoin, but that also pushed the price down. They halted Bitcoin buys, pushed the price down. Then they sold Bitcoin, again, 32 billion, pushed the price down. It's also down about 50%. But the other thing we want to keep in mind is compared to what? How does 8% drawdowns compare to what? Well, the fixed income market is the largest market in the world. $350 trillion of fixed income. It's 3 times larger than the next biggest market, right? Than the equity market. And so some people just need income. Not everybody can buy Bitcoin and wait for 5 years. Some people need income right now. Yield-seeking capital. And currently, all of that 350 trillion of yield-seeking capital is based off of equities and bonds on a dollar standard. Now, the demand for that yield doesn't go away. It just transfers. Already about 13 billion, which is nothing out of 350 trillion, 13 billion has moved over to be backed by Bitcoin. And eventually more and more and more. And so if we have, let's say, this $350 trillion pie, all USD denominated, eventually we get 2, 4, 6, 100 billion, right? The point is this pie keeps growing. So this is a Bitcoin denominated pie. And what happens is more and more and more starts moving over. The 350 trillion demand doesn't go away, but maybe this goes 100 trillion and this drops to 200 trillion. We're witnessing the entire bedrock of the global financial system be switched out in real time. Okay.
What happens when a market stops reacting to size and starts reacting to signals instead? A tiny Bitcoin sale, barely noticeable in terms of holdings, suddenly becomes enough to shake sentiment across the entire crypto space. Why would such a small move carry so much weight? The answer sits in perception. When institutional players begin prioritizing liquidity proof and credit validation over accumulation narratives, every action starts to matter far more than its actual scale. But here's the real tension. Does this signal strength or uncertainty? Is it a strategic move to satisfy traditional finance expectations, or the first sign of shifting behavior under pressure? In a market already driven by fragile confidence, even symbolic decisions can ripple into price action, leverage, and sentiment almost instantly. And that leads to the bigger question. If tiny moves can move markets this much, what happens when the next real wave of institutional action arrives? If this breakdown helped connect the signals behind the move, share your thoughts in the comments. Share this with others watching the market, and subscribe for more deep analysis like this. Do you think Bitcoin is being driven more by real buying and selling, or by institutional signals and market perception right now?